Chapter 8, we will be covering group insurance and some of the most common characteristics of group insurance. Um, group insurance, what group insurance is typically life insurance that is provided through an employer. Okay. I know that's not how you spell through, but we'll just abbreviate it. But it's provided through an employer, typically where you'll see group insurance. Why? Because they're insuring a whole group of employees. So that with characteristic number one is that it must be a natural group. So what does that mean? Is that the group has to exist for a reason other than just to buy low cost life insurance. So what does that mean is if let's say Starbucks, an employee of Starbucks or the employees of Starbucks can have group insurance. Why? Because they are employed by Starbucks. Therefore, it's a group that of people that's employed by Starbucks. An alumni group, right, from a college, from a university, they can apply for group insurance. Why? Because they are an alumni group, right? It has nothing to do with just putting a group together to buy low cost insurance. Now, an example of that, um, so the minimum also in the state must be 10 people for it to be considered a group. So for example, let's say I walked into a Starbucks and I asked nine other people in the Starbucks if they wanted to form a group with me to apply for group insurance. An insurance provider, an insurer will look at that and they'll say, okay, why was this group formed? And they let's say they ask a couple of the people and the people say, oh well, he just asked, he walked into a Starbucks and he asked us if we wanted to form a group with him so we could get low cost insurance. The company is not going to approve that because it is not a natural group. It was a group that was created just to buy low cost insurance. Okay. So first characteristic is that it must be a natural group and the minimum number must be at least 10 people to be considered a group. Now, characteristic number two is that there is a master policy and there is a certificate of insurance. Now, the master policy is given to the employer. For example, Starbucks, they are they will have the master policy. What is a master policy? Basically, everything that is covered, everything that is excluded from the policy, beneficiaries, all that will be in the master policy. That is given to the employer. The employees, so all the employees of Starbucks that apply for the group insurance will only receive a certificate of insurance. So just think a certificate is a piece of paper, right? They're going to get a piece of paper that just says that they are covered under that group plan. Okay, so a certificate of insurance is given to the employees. A master policy or master contract is given to the employer. Characteristic number three is that no evidence of insurability is required. So no evidence or no proof. Remember, there's those two words, evidence or proof of insurability is required. So what that means is that the individual that's applying for the group plan or anyone that applies for the group plan does not have to show proof of insurability, meaning they do not have to do a blood and urine exam. Why? Because everyone that is covered under the group plan will be insured, will be covered. Okay. Now, there are exclusions. So that doesn't mean that just because they're covered under the group plan, that if they pass away, that the company's going to pay out. Why? Because there's exclusions that are in that master policy that state that. That's why the employees, they just get a certificate of insurance. So characteristic number three is that no evidence or proof of insurability is required. And then the second part there is that premiums are based on experience rating. So what that means is that they're going to go based on their experience from the year prior to calculate their premiums. So for example, let's say they had 100 people that applied for the group plan And of those 100 people, none of them passed away. So they all were stayed alive. So that may lower the premium a little bit because based on the experience of the previous year, everyone was fine. So they may lower it a little. Let's say of the 100 people, maybe 30 of them passed away last year. That means 30% of the 100 passed away. So that may cause the premium to go up a little bit. Okay. So how they're going to calculate the premium is based on the experience rating, like what the past experience has been for that group. The fourth characteristic is that it is typically funded by annual renewable term. So if they're going to look back at the experience of last year, then typically it'll be funded by annual renewable term. Why? Because then they can renew the term every year. That therefore they can change the premium. They can, charge a little bit more or maybe charge a little bit less. But that only happens through annual renewable term. Okay, where it's a term for a year. Characteristic number five is that the conversion privilege is 31 days. What that means is that, for example, let's say I'm an employee at Starbucks. I have group insurance through Starbucks. I'm part of the group, right, life insurance plan there. I decide to leave Starbucks and I decide to go work elsewhere. I have 31 days to convert that policy from a group plan to an individual. Okay, so to convert from group to an individual policy without having to show evidence of insurability. So I don't have to do a blood and urine exam. I can just convert my group plan to a individual plan where I don't have to show evidence of insurability. Now, the cost will go up because now I don't get the group discount. It's an individual policy. So I'll have to pay a little bit more out of pocket. But that only happens within 31 days. Let's say I decide to do it 33 days after I've left Starbucks, then I do have to now show proof of insurability in order to be covered. Okay. But within those 31 days, those first 31 days, there's no evidence of insurability that's required. Next is a contributory group plan. So it'll be written as contributory group plan. And what a contributory group plan is, just think of it this way. It's a group policy where the employee contributes to it. So just think they're going to pay a small portion out of their paycheck every pay period to the group plan, to the insurance. Okay. So just think contributory group plan is where the employee contributes money, okay, to the plan. So they're going to pay a small portion of the premium themselves. So when it is a contributory group plan, 75% of the eligible employees must participate. Okay? So 75% of the eligible employees must participate in a contributory group plan. When it is a non-contributory group plan, so when it is non-contributory, what that means, so non-contributory group plan, that means that the employees do not have to contribute anything. So employees pay zero. Okay, so the employees do not have to contribute to this group plan, meaning the employer is paying for all of it. When it's non-contributory, 100% of those employees must participate. Okay, because they can't say, oh, well, I'd like to be part of it, but I can't afford it. Right? I need my whole check. The company's saying, hey, well, we're paying for everything. Nothing's coming out of your pocket. So we need all 100% of the employees to take part in it. Okay. And then the last characteristic here is that $50,000 is the most coverage to be tax exempt on a group plan, on a group insurance plan. So there will never be more than $50,000 of coverage. Why? Because 50,000 is the max. Anything after that, the company, right, the employer cannot use as a tax deductible. Okay. So 50,000 is a max, and it can be anything below 50. It could be 10,000, 20,000, 25, 30, 40,000, but nothing over 50,000 because then it will not be tax exempt. Now, continuing on here as we go into ethics. So ethics, just think of it, it's about doing the right thing, right? You're dealing in good faith. You have ethics. You're doing what's right for the customer. Now, discrimination. So in insurance, there you cannot discriminate against someone based on their race, based on their color, based on their religion. Those three are pretty common sense, right? You can't discriminate against someone based on their race, based on their color, based on their religion. Now, in insurance, you also cannot decide to charge a higher premium to someone who earns more money. So, for example, let's say, a 40-year-old male applies for insurance and he's a truck driver and he makes $50,000 a year. He's 40 years old. He applies for, $250,000 of coverage. His premium is going to be, let's say, $100 a month. Let's say Elon Musk applies for the same insurance, right? $250,000 of coverage. Let's say he's also 40 years old. The company cannot look at his name and his income and say, okay, well, he can afford $10,000 a month. So let's charge him, right? We know the other 40-year-old truck driver makes $50,000 a year. Let's charge him $100 a month for $250,000 of coverage. But let's charge Elon Musk, who's a billionaire, let's charge him $10,000 a month for the same $250,000 of coverage. You cannot do that, right? That is discrimination based on income. Okay. Now, what a company can discriminate against is reckless behavior. So, for example, let's say the individual has multiple speeding tickets in the last year. Then a company, if they see that, they can discriminate against the individual, one, by not covering him, or two, if they do cover him, they can rate the policy. It'll be rated, meaning it's going to be a little more expensive because he's a higher risk, right? Because he is reckless. Okay. And just finishing up here, a couple policies. So the first is that personal judgment is not required in life insurance. So what I think of a client is not required in the life insurance application, right? The company is always just going to go based off of health. They're not going to, oh, he talked too much, or oh, he drank 2 liters of Coca-Cola while I was there. That's irrelevant. The company's always going to go look at their medical history, medical records, blood and urine exam if required, and make their decision based off of that, not off of personal judgment. And lastly is the term conservation. So conservation is when an agent tries to deter, and that's the key word there, deter an insured from getting a new policy. So what that means is, for example, if I have a client and an agent from another company tries to come over and sit with my client and sell them another type of life insurance policy that is not going to be more beneficial to them. Maybe it's going to give them the same coverage, but it's going to be more expensive, or maybe it's going to be less coverage and more expensive. Then my job as an agent is to go conserve my business. Conservation is I'm going to go sit with the client and say, okay, let's take a look at the policy. Let's compare apples to apples. Let's see what makes the most sense. And ultimately, whatever's going to make the most sense is what's going to be best for the client. So conservation is you're just working on conserving your business. So you're deterring a client from getting a policy that is not going to be more beneficial to them. Okay. There's no more added benefits to it than what they currently have. Okay. So that is chapter 8. Once again, short chapter, but please make sure that you review this, because from these 7 characteristics that you see on here, they can pull multiple questions out of this to test you and quiz you on group insurance.